Hello and assalamu alaikum, boys and girls. So, in this video, we'll be discussing objective test questions of Section A of Financial Reporting FRF7 paper. Right, so let us start with it. IA 16 property, plant, and equipment requires an asset to be measured at cost on its original recognition in the financial statements. EW used its own staff assisted by contractors when required to construct a new warehouse for its own use. Right. So identify whether the cost listed below should be capitalized or expensed. Okay. So, well, clearance of the site prior to the commencement of construction, it will be capitalized. Professional surveyor fees or managing the construction work, it will be capitalized. Okay, EW own staff wages for time spent working on construction, yes, it will be capitalized. And the proportion of EW administration cost based on staff time span, it's the expense. So the allocation of EW's administration costs would not be included as these costs are not directly incurred as a result of carrying out the construction. All of the other costs which would not have been incurred without the related assets being built. Okay, next question. On 1st July, okay, on 1st July 2004, the ex the experimenter opened a chemical reprocessing plant. The plant was due to be active for 5 years until 30th Jan 2009. Okay, when it would be decommissioned. At 1st July 2004, the cost of decommissioning the plant was estimated to be 4 million in 5 years' time. The experimenter considers a discount rate of 12% is appropriate for the calculation of a present value, and the discount factor at 12% of 5 years in 0.567. What is the total charge to the statement of profit or loss in respect of the decommissioning for the year ended 30th June 2000 X5? So the cost of the decommissioning is assumed to be an obligation for the entity, and amount should be included in the cost of the asset when it is first recognized. Okay, it was when it was first recognized, it was first recognized on 1st July 2000 X4. So the amount to include in the cost of asset for decommissioning cost is the present value of the expected future decommissioning cost. The present value is calculated by multiplying the expected future cost by a discount factor, which in this case is the discount factor for the year 5, 2009, at 12%. So for that, it is 4 million. And the discount factor for the fourth year for 2000X9 is 0.567. So it is 2.268 million. So therefore, what will happen? Cost of asset debit 2.268 million, and credit provision for decommissioning cost 2.268 million. So the asset is depreciated on the straight line basis over 5 years. In addition, the decommissioning cost should be increased to 4 million by the end of year 5. This is done by charging a finance cost each year. This is charged at a cost of capital, which is 12%. Cost of capital is 12%, right? And and apply to the balance on the provision account. The finance charge for the 30th June X5 is 2.268 million into 12%, and we get 272,160. Okay, I hope it is clear till here. Okay, question number three. Um, an entity purchased property for 6 million on 1st July 2003. The land element of the purchase was 1 million. The expected life of the building was 50 years and its residual value is nil. On 30th June 2005, the property was revalued to 7 million, okay, of which the land element was 1.4 million and the building 5.76 million. On 30th June 2007. The property was sold for 6.8 million. So, what is the gain on disposal of the property that would be reported in the statement of profit or loss for the year to 30th June 2007? A, B, C, D, the answer. So, let us look at the solution now. So, let us solve it. And for that, yeah, let us solve it here. Separate. Okay. Let us give the. No, don't do this. What's happening? It's writing here. Why not writing there? Don't do that to me. Don't do that to me. So let's open one more. Why not? Oh, yeah. Actually, OneNote is angry that why not you using overall me. So open the separate app and here it is. We have land, we have building, and the total element, right? So the cost on 1st July 2003 is 1, building is 5, total is 6. Building depreciation 5 million divided by 50 years is 0.1 million. Into 2 years we get building point 0.2, total is 0.2. 1, it's 4.80 and 5.80. Just a second. So, cost on 1st July is 1 million. Building cost is 5 million. Total is 6 million. So, and then building depreciation 5 million out of 50 years, is, 0.1 million for 2 years. It's 0.2 million for the building, right? So the carrying value is 1.4 and total is 5.8. Now we have revaluation gain. Revaluation gain 0.24, 0.96, and total we got 1.20. Now what's the revalued amount? Revalued amount 1.24, 5.76, and the total is 7. Now, again, after revaluation, we will do the depreciation of the building. So, building depreciation is 5.76. Now, the life left is 48 years. So, it's 0.2 2 million into 2, we got 0.24, and it's 0.24, 1.24, 5.52. At total, I got 6.76. 6.76. We disposed the asset for 6.8. So gain on disposal. What's that? 0.04. I hope it is clear that gain on disposal is actually $40,000. The 1.2 million balance on the revaluation reserve is transferred from revaluation reserve to another reserve account known as revaluation reserve. Revaluation reserve to another account. Probably it could be retained earnings, but it is not reported through the statement of profit or loss for the year, right? And if you selected answer B in this case, you have forgotten to record depreciation between 30th June and 30th June 2007. If you selected answer C, you have based the profit on the original depreciation. You selected D. If you selected D, you have incorrectly transferred the remaining revaluation reserve into the statement of profit or loss. I hope you get it till here. And so our answer in this case is A. Now, next question. A manufacturing entity receives a grant of 1 million towards the purchase of a machine on 1st January 2003. The grant will be repayable if the entity sells the asset within 4 years, which it does not intend to do. The asset has a useful life of 5 years. What is the deferred income liability balance at 30th June 2000 X3? Okay, let me try once again here. Why not? It's working. Uh, one more try. Yeah, now it's working. So, next question. Let us try with it. As we know that the grant should be released over the useful life, right? So the based on the possibility of the item being repaid, therefore the 1 million should be released over 5 years. Over 5 years, right? So 1 million should be total amount is 1 million, right? And it should be released over 5 years. So divided by five, we got 200,000, right? A year. At 30th June 2000 X6, somewhere here, 30th June X6. It's 6 months, which should be released, meaning 100,000 has been released. Uh, how? For full year, it's 200,000, right? So it's 6 divided by 12 means 1,000 is released, and remaining 100,000 has been released. This leaves 900,000 in deferred income. So our 900,000 is our deferred income, right? So the answer is 900,000. On 1st January 2000 X1, by stay received 1 million from the local government on the condition that they employ at least 100 staff each year from the year 4 years due to an economic downturn and reduced consumer demand on 1st January 2000 X2. Stay no longer needed to employ any more staff, and the condition of the grant required full repayment. What should be recorded in the financial statements on 1st January 2000 X2? Huh. Reduced deferred income balance by 750,000. reduce deferred income by 750,000 and recognize a loss of 250,000. So in this case, B is our answer. Yes, B is the answer. This is a revenue grant and would therefore be released on the statement of profit or loss. And this over the 4 years life, by the end of the year one, 250,000 would have been credited to the statement of profit or loss, leaving 750,000 held in deferred income. At this point, the amount is repaid, meaning that the deferred income is removed as well as the 250,000 income previously recorded. If you selected A, you have not removed the income that was released in the prior year. If you selected C, you have missed that 250,000 would have been released in the previous year. If you have chosen D, you have made errors over the deferring of the grant that the repayment would be treated as an expense. Next question: which of the following properties owned by Scoop would be classified as an investment property? A property that had been leased on the to a tenant but which is no longer required and is now being held for resale. No. A land purchase for its investment potential planning permission has not been obtained for building construction of any kind. So yeah, D is the answer. Okay. As asset would be classified as non-current asset held for sale under IFRS 5, held for sale and discontinued operation. C and D would both be classified as property, plant, and equipment as per IS 16. Now, next question I have: during the current year, an entity had in place 1 million of 6% loan finance and 2 million of 9% loan finance. It constructed a new factory which cost 600,000 and this was funded out of the existing loan finance. The factory took 8 months to complete. The nearest thousand, what borrowing cost should be capitalized? Now the seventh one. Let's do this. So, well, the weighted average cost of borrowing is 8%. How? How we will get this 8%? See, 1 million into 6% plus 2 million on 9% over the 3 million. So we get overall 8% like that. And the amount to be capitalized, 600,000 into 8% into for 8 months, 8 divided by 12, we got 32,000. That's how we'll do it. Okay. Next, move on. Which of the following statement is correct? Statement one: if the revaluation model is used for property, plant, and equipment, revaluations must be subsequently be made with sufficient regularity to ensure that the carrying amount does not differ materially from the fair value at each reporting date. Okay. And when an item of property, plant, and equipment is revalued, there is no requirement that the entire class of asset to which the asset belongs must be revalued. Okay. First statement is correct. Second statement is incorrect. IS 16 states that when the revaluation model is used, revaluation should be made with sufficient regularity to ensure that the carrying value of the assets remains closer to the fair value. IS 16 also states that if one item in a class of asset is revalued, all the assets in that class must be revalued. Okay. Now, nice one. Next one. Next one. Question number 9. Let's do it. Hotel company received a government grant of 60,000 on 1st September 2008. For the condition of the grant state that the hotel company must employ a local worker on a full-time contract over 5 years period. Hotel company expect to meet the condition of the grant. The full grant has been recorded as other income of for the year ended 31st December 2004. What is the adjustment required to account correctly for the grant as at 31st December 2004? Now, you know, as far as this is concerned, other income, debit 56,000 and credit is total deferred income. So the grant of 60,000 represents, how much? Let's see. Let us move back here. 60,000 represents 5 years. Okay, that means 12,000 and per month it's dollar 1,000. Per month it's dollar 1,000. So portal company should only have recognized how many? 1 month, sorry, 1,000 into 4 months, we get 4,000 of income in the statement of profit or loss for the year ended 31st December X4 with the remaining, you know, 56,000. This remaining 56,000 will be recognized as deferred income in the statement of financial position. The correcting journal entry therefore required is therefore to debit other income and credit total deferred income, which I did. Other income debit and deferred income credit 56,000. I hope you get it. Now, next question. Tibet acquired a new office building on 1st October 2004. Its initial carrying amount consisted of land 2 million, building structure 10 million, and air conditioner system 4 million. Okay. Total is 16 million, 16,000. The estimate lives of the building structure and air conditioning systems are 25 years at 10 and 10 years respectively. When the air conditioning system is due for replacement, it is estimated that old system will be dismantled and sold for 500,000. Depreciation is time apportioned where appropriate. Okay. At what amount will the office building be shown in Tibet statement of financial position as at 31st March? So the year end is 31st March. That means year was started in April, right? So see over here carefully. 31st March, right? 1st April, X4, and they bought the building, or sorry, yeah, they acquired a new office building on 1st October, X4. Here. So here, they year starting on 1st April, right? They acquired the new building on 1st October. So October, November, December, October, November, December, January, February, and March. That means 6 months, right? That means 6 months. So 6 months depreciation is required on the building structure and air conditioning system. And remember, the land is not depreciated, right? So land not depreciated, 2,000. I am taking millions into thousands, okay? And building structure, move. So building structure, 10,000 divided by 25,000 years into 6 divided by 12. Uh, is there any scrap value? Just look once again. Yeah, no. So move on. The carrying value is 9,800. Air conditioner system, 4,000 minus 3,500 and divided by 10 into 6 divided by 12. We got 3,825, 3,825. We got 15,625 here overall. You know, I hope it is clear till here. Well, the cost was 4 million and the dismantling cost of, or you can say, yeah, dismantling cost 500. So that's why I took 3,500 divided by 10 into 6 divided by 12, right? I hope it's clear now. It's clear. Now to the next question. The following trial balance extract relates to the property which is owned by Wheaton as at 1st April 2004. Property at cost 20 years, original life 12,000, accumulated depreciation as at 1st April 2004, 3,600 on 1st October 2004. Following a sustained increase in property prices, Wheaton revalued its property to 10.8 million. What will be the depreciation charge and Wheaton's statement or of profit or loss for the year ended 31st March 2005. Uh, let's move on. Let us move on further. So once more, trial balance to property which is owned by Wheaton as at 1st April X4. 1st April X4 and year end here is 31st March X5. Fine. So let's do this one over here. Year end 31st March S5. 1st April X4. So April, May, June, July, August, September. After 6 months. So 6 months depreciation here in September, date of date on which we, revalued the asset. Actually, they have revalued it to 10.8 million. Okay. Now, 6 month depreciation to the date is 12,000 divided by 20 years. We got 300,000. So 300,000 into 6 divided by 12. 6 months depreciation from the date of revaluation to 30th first March Act 5 would be, 400,000. Now the net depreciation after the revaluation is, as it's revalued to 10,800. The remaining life is 13.5 years. We got 700,000, and that's our answer. Moving further ahead, which two of the following statement would about IS 20 accounting for government grants and disclosure of government assistance are true? Okay, a government grant related to the purchase of an asset must be deducted from the carrying amount of the asset in the statement of financial position. No, this is not true. A government grant related to the purchase of an asset must be deducted from the carrying amount of the asset in the statement of financial position. Not good. A government grant related to the purchase of an asset should be recognized in profit or loss over the life of asset. Pre-marketing advice provided by a government department is excluded from the definition of government grant. So B and C are the correct answer. Item A is not correct as the deferred income method can be used. Item D is incorrect as any repayment is corrected in the current period, not retrospectively. Now, let's move further ahead. Smithson Company purchased a new building with a 50-year live for the 10 million on 1st January 2003. On 30th June 2005, Smiths and Company moved out of the building and rented it out to third parties on a short-term lease. Smiths and Company uses the fair value model for the investment properties. At 30th June 2005, the fair value of the property was 11 million, and at 31st December 2005, it was 11.5 million. What is the net investment to be recorded in the statement of profit or loss in respect of the office for the year ended 31st December 2000 X5? Okay. Let's solve it. Year end is 31st December. We purchase a new building with a 50-year life for 10 years in 1st January X3, 2 years back. On 30th June X5, Smith Company move out of the building and rent it out to third parties on a short-term lease. Smith Company uses the fair value model for investment properties. At 30th June X5, the fair value of the property was 11 million, and at 31st December X5, it was 11.5 million. Okay. So 6 months depreciation should be accounted for up to 30th June 2000 X5. Okay. That's for this question number 13. Okay. 1st January, 31st December. Okay, 6 month depreciation should be accounted for up to 30th June 2000 excise, which is 100,000 expense. How? 30th June, right? Here it is. Here, 10 million. Life is 50 years into 6 divided by 12 for the 6 months. We got 100,000, right? So when its asset is transferred to investment property, it should be revalued to fair value of 11 million at that date. Asset use is changed, its gain should be recorded in other comprehensive income and in a revaluation surplus, not in the statement of profit or loss. From this date, the fair value model is used. So no depreciation is required, but the asset will be revalued to fair value gain or loss going through to the statement of profit or loss. Therefore, a gain of 500,000 from June to December, from June to December, a gain of 500,000 is required. and this would be included in the statement of profit or loss. Therefore, the total net income will be 400,000, being the 500 fair value gain. 500 is the fair value gain, okay, and less the depreciation expense. That 100 depreciation expense will be reduced. So overall gain is 400,000. So the answer is net income of 400,000. Now, so far, so good. I hope you get it till here. So, next question. Gilbert took out a 7.5% million, 10% loan on 1st January 2006 to build a new warehouse. During the year, the construction of the warehouse began on 1st February 2006 and was completed on 30th November 2006. As not all the funds were needed immediately, Gilbert invested 2 million in 4.5 bonds from 1st January to 1st May 2006. What are the total borrowing costs to be capitalized in respect of the warehouse? Okay, right. So, as you remember, you may remember that interest can only be capitalized during the period of construction, which is from yeah here 1st February Act 6. So interest can be capitalized for 10 months on from Feb to 30th November. It will provide us 7.5 million into 10% into 10 divided by 12, 625,000. Any temporary investment income earned during this period should be netted off uh, the amount capitalized. The amount earned from 1st February to 1st May 2006 is the first Feb to you know 1st May, February, March, April. That is 2 million, 4.5%, and it's 3 months. In total, we get 22,500. Therefore, the amount to be capitalized is 625,000 minus 22,500 is 602,500. All interest incurred and earned in January excess is before the construction period and therefore is recorded in the statement of profit or loss. So 602, 500 is the answer. Oh, 602, 500. Now, next question. Croft acquired a building with a 40 years life for its investment potential for 8 million on 1st January X3 at 31st December X3. The fair value of the property was estimated at 9 million, with cost to sell estimated at 200 million. If Croft Company uses the fair value model for the investment properties, what gain should be recorded in the statement of profit or loss for the year ended 31st December 2000 X3? I hope you get it till here. And so the fair value gain of, the gain is 9 million minus 8 million. We get 1 million, right? Should be taken into statement of profit or loss. Cost to sell are ignored. And since Croft uses a fair value model. No depreciation will be charged on the building. So it's 1 million. That's it. And that's it for now for the section A questions. We will continue it in our next video next time. Till then, take care. Bye bye.